Welcome back. You're watching Business Morning on Channels Television. Now, over the weekend, JP Morgan said it was going to extend the deadline for the negative watch it placed Nigeria on. That's on its GBI-EM. Now, remember, in January, it placed Nigeria on negative watch after the CBN introduced several new policies in the foreign exchange market that some viewed as capital controls. Now, we're talking what could happen if Nigeria is yanked off the GBI-EM. Well, Johnson Chukwu is the Managing Director of Cowry Assets Management. He joins me now to talk more about this. Good morning, Mr. Chukwu. It's a pleasure to have you on the program. So what do you make of this latest decision by JP Morgan?
Well, I saw it come. If you recall, I was in your studio sometime when they made the announcement they're going to take Nigeria off the emerging global government bond index emerging markets if liquidity does not improve. And you see, basically, for any bond to qualify for inclusion in government bond index emerging markets, that local currency bond must have some level of liquidity. Because of administrative controls, where central bank said it's not capital controls, there is very low liquidity in the interbank market. And therefore, investors in Nigerian local currency bond instruments find it difficult to exit, because you are not going to find the liquidity for those who want to buy. And if you don't have liquidity for dollar liquidity for those who want to buy, you're not going to have liquidity for those who want to sell. So it was expected, because if you remember when they took that decision, it was when the central bank came out with a policy of zero open position limit for banks, which completely dried up liquidity in the market, in the FX market. Central bank had to reverse that to some extent by increasing it to 0.5%. But we still have a lot of constraint in accessing liquidity in the interbank market, the FX interbank market. And for those who are tracking the Nigerian local currency bonds, they are really in positions where they can't easily sell. And that's what JP Morgan is saying, that unless liquidity is restored to that market, they may have no choice than to take Nigeria out of the global.
But the central bank has consistently said that they've put in place policies, they've put in place measures to ensure that this does not happen, that there's more liquidity in the market, and they're saying that JP Morgan should actually be talking, their team should be talking to their own team. These two teams should come to the table and look at the situation and look at the issues as it is. We're providing liquidity as much as we can. Why don't you cut us some slack?
Well, when the central bank said they are doing a lot of things to restore liquidity into the system, I don't know if they were very specific on those things they are doing. In as much as I recognize the fact that CBN is constrained, because our reserve is quite low. We're talking about $29.4 billion. Our foreign exchange earnings is also low because our production is low. We're doing about 1.86 million barrels per day instead of about 2.23 that was budgeted. Crude is selling about $63 today compared to what it was sometime by this time last year. So I recognize the fact that the central bank is constrained in supplying dollar to the market. But if we are talking of the policies that we have in place, that the most appropriate we should, I think there are areas that there are opportunities to have some adjustments. For instance, the issue of exchange rate. Because analysts and foreign investors believe that Nigeria's Naira is still overvalued, they are not in a hurry to bring in foreign currency liquidity to the system. So we may need to look at, and as long as your currency is overvalued, investors will want to exit your market. They wouldn't want to wait until that devaluation takes place. And those that want to come in will not come in until the devaluation takes place. So you're in a catch-22. Those that want to exit, those that are holding your instrument want to exit because they think your currency will further devalue. Those that want to come in cannot come in because they think your currency will further devalue, and they don't want to come in now, and they have exchange losses. So the question we have to ask ourselves, do we need to artificially prop Naira at current level when our foreign exchange earning cannot support our current exchange rate? And that's the key question we need to ask. If you devalue the currency today, foreign portfolio investors, once you get to the point where the downside risk of further devaluation is lower than the upside risk of appreciation of the currency, then foreign portfolio investors will find your instruments attractive again, and they begin to come back.
But then if you devalue the Naira, yes, we want the foreign portfolio investors to come back, but then we also have to remember that the economy is in dire straits. We have issues on ground that need to be also addressed. And so it's like the CBN is between the devil and the deep blue sea. Which side will he go? Or will they go?
You see, my approach to economic management is always this. Economic managers or key decision makers should define what is of priority to them.
Of priority to them right now should be the economy.
And I think, yes, I said, you see, the managing an economy is a balancing act. I think I've always said this in your program. It's a very delicate balancing act because economic variables move in different directions. If today you devalue the currency further, you're going to have inflation uptick. Then, but that devaluation should stimulate local production of goods and services because import will become more expensive. Again, when you devalue further, you get to a point where even if outside investors, foreign investors will believe your currency is not going to be there because the value go down further, and then they begin to come into your market. Remember what you're looking at is this. The supply of foreign currency is low, while the demand for foreign currency is higher. Part of the reasons why our foreign reserve got to 40-something billion about 2 years ago was because of inflows from foreign portfolio investors. And if you remember, in January 2012, JP Morgan for the first time included Nigeria in the government bond index emerging markets. And that led to a lot of foreign portfolio patronage of the Nigerian instruments. Fund managers that were not conscious of even Nigerian instruments began to add Nigerian bond instruments into their portfolio.
Mr. Johnson Chukwu, please hold on to that thought. I need to take this breaking story at this time. Even as the 8th National Assembly begins, Senator Bukola Saraki has been elected as the Senate President. He was nominated and elected unopposed. This is a breaking news story. As the 8th National Assembly begins, Senator Bukola Saraki has been elected as the Senate President. He was nominated and elected unopposed. Of course, you can keep your eye on Channels Television to see how this story develops. We'll continue to track this for you until the end of the show. Mr. Chukwu, please continue with your thoughts on that.
So basically, for us to stimulate foreign portfolio inflows, we need to have an exchange rate that mirrors the value or the strength of our economy. Current exchange rate does not effectively reflect the strength of the economy, particularly in terms of foreign exchange earnings. And as long as you have that, the central bank will be compelled to maintain administrative bottlenecks, controls in exchange. What they have is what they call another quote system. So in effect, you need to submit your bid indicating what you want to use the funds for, and then they will now determine whether your bid or what you want to use the funds for is of priority to central bank. So, and I don't, from my experience, I don't think they consider those who are bidding to buy foreign currency instruments as of priority.
Now, Mr. Chukwu, do you think that the CBN should, shift in their stance at this time? Because the reason why JP Morgan said they had given a further 6 months extension to the end of the year was because of this new administration of President Muhammadu Buhari. It's actually suggesting that they're hoping that President Buhari and his officials, can actually put a little pressure on the independent CBN to reverse some of its unpopular policies.
Well, not necessarily to put pressure on the independent CBN. By the time the new government comes up with economic policy blueprint and defines how it wants to drive the economy, the monetary policy authorities will have to adjust monetary policy parameters to support fiscal policies. And I think that's what JP Morgan is waiting for. If, for instance, like I said, the government in power decides that they're going to adopt an expansionary monetary policy or expansionary fiscal policy, they're going to stimulate the economy by injecting liquidity into the system, then the central bank will have no choice than to allow Naira to devalue and be willing to take a high level of inflation. But if the government comes and says, we want to maintain contractionary monetary policy, and then you're not going to see the growth in the economy that one is expecting. You're not going to see the employment generation that the party has promised. So I think what JP Morgan is doing is waiting to see what will be the economic policy directions. That will now define every other policy orientation in the economy, including monetary policies.
But then, going forward now, do you expect to see that, well, we know that the new government might likely, be borrowing, to fund some of the deficits that it's going to be having. And if there's a possibility that JP Morgan does go ahead and removes Nigeria from the GBI-EM, that means we're going to have a very high interest rates, and so borrowing also is going to come at a high cost.
Well, the multiplicity of implications of removing Nigeria from the government bond index emerging markets. One is, like you mentioned, the rate at which government borrows. And you remember this, we're talking about local currency instruments.
Yes.
The rate, the yield on federal government bonds will have to go up because the demand will be largely limited to local investors. Unlike now where you have a reasonable percentage of foreign investors. Because those who are tracking, those funds, foreign funds who are tracking Nigerian local currency instruments, will take them off their portfolio. So the demand for Nigerian local currency instruments will decrease. And therefore yield will have to go up to attract the limited local fund managers to invest in it. Second factor is that the rate of inflow of foreign exchange into the economy will diminish. Because those inflow that we are coming as a result of foreign portfolio investors buying into Nigerian local currency bond instruments will cease. Third factor, the demand for dollar will increase by those funds that will be selling off their local currency instrument to exit the Nigerian market, which will lead to further depletion of your reserve. So these are multiplicity of factors that will happen if JP Morgan carries out a threat to eject Nigeria from the government bond index emerging markets. Well,
interesting days ahead. So, Mr. Johnson Chukwu, all of us are going to keep our eye on this developing story and hope that by the end of the year, it doesn't actually happen. Nigeria still remains on this index, the GBI-EM. But thank you so much for coming on the program and sharing your thoughts with us.
My pleasure.
Johnson Chukwu is the CEO of Cowry Assets Management. Business Morning will continue in just a moment. But just before we go on this quick break, news just in. Even as the 8th Assembly begins, Senator Bukola Saraki has been elected as a Senate President. He was nominated and elected unopposed. Continue to follow Channels Television to get more on this developing story. We'll be right back.